Welcome to Balance of Economy. Before we break down the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers.
We're kicking things off with an absolute juggernaut of a number. $81.6 billion. That's NVIDIA's Q1 revenue for fiscal 2027. I mean, to really put that into perspective, it's an 85% jump year over year. The data center segment alone, which is practically the beating heart of this entire company right now, accounted for over $75 billion of that total. And their bottom line? An earnings per share of $1.87. That completely blew the consensus estimate of $1.76 right out of the water. Honestly, from a purely fundamental standpoint, these are exactly the kinds of numbers that historically send a stock straight into orbit.
But here's the paradox we're unpacking today. The expectation was, a massive earnings beat followed by just continued hyper-growth in the stock's valuation. But the reality? The stock price basically stalled and actually dropped about 1% in after-hours trading. Despite delivering what CEO Jensen Huang literally called the largest infrastructure expansion in human history, the market barely blinked. Seriously, this marks the fourth consecutive time NVIDIA's stock has basically failed to launch after an earnings beat. So what's really going on here? Well, here's what you need to understand to protect your capital. To make sense of this paradox, we're going to break this down into four key areas: the perfection trap, the hardware competition, the shift to inference, and finally, undervalued alternatives.
All right, let's dive right into Section 1, the perfection trap.
So the perfection trap is a very specific, almost mathematical market condition. It happens when a stock's valuation already bakes in several years of absolutely flawless future execution. When you're trading at a multiple of roughly 45 times earnings and sitting at a multi-trillion-dollar market cap, we're talking over $5.3 trillion at its peak, massive earnings beats, they're no longer treated as positive surprises. They are literally just the baseline expectation needed to justify the current price tag. Any slight deviation or, even just merely meeting that insane standard, well, it gets treated by algorithms and momentum traders as a major disappointment.
If we just look at the historical data over the last 5 earnings reports, the pattern is pretty clear. In 4 of these instances, including Q4 of fiscal 2026 and now Q1 of fiscal 2027, NVIDIA beat Wall Street's estimates, yet the stock either saw a slight correction or actively dropped. The market is effectively pricing in the peak. The debate among institutional capital isn't whether NVIDIA is a great company anymore. It absolutely is. The real debate is how long this hypergrowth can realistically last before the law of large numbers just inevitably takes over.
Having said that, we do need to maintain a cold, objective view of the present reality. Right now, NVIDIA still holds an absolute, crushing monopoly. They control an 81% share of the AI data center chip market. Their CUDA programming software and NVLink hardware connections essentially create this massive walled garden. It makes them the default, rational choice for anyone looking to train massive AI models today. And believe me, this is exactly the prize the hardware sector is fighting over. Just look at the sheer scale of the battlefield here. Hyperscalers are projecting a staggering $725 billion in 2026 capital expenditures. We're talking Amazon committing $200 billion, Microsoft at $190 billion, and Meta guiding up to $145 billion. That is the pie. Now, NVIDIA is currently taking the lion's share of that capital, but let's be real. These hyperscalers do not want to be forever dependent on a single vendor pulling in 75% gross margins.
Which brings us perfectly to Section 2, the hardware competition.
The most significant tectonic shift right now is happening between Google and Anthropic. Google has locked in this incredibly aggressive expansion with Anthropic, involving an investment of up to $40 billion. But what really matters here is the physical compute. They are securing 5 gigawatts of compute capacity, with 3.5 gigawatts explicitly coming from next-generation Google TPUs, which are co-designed by Broadcom. Anthropic is using a multi-platform strategy. They're running on Google TPUs, Amazon Trainium, and NVIDIA GPUs. They are proving, right now, that you don't actually have to be locked into NVIDIA's ecosystem to train frontier AI models.
Let's look at a cold spec comparison for a second. AMD's upcoming MI400 is bringing 432 gigabytes of HBM4 memory capacity and 19.6 terabytes per second of bandwidth. Guys, that is more than double the memory capacity and bandwidth of NVIDIA's flagship Blackwell B200. Why does this matter?
Well, because for many real-world workloads, especially large language models that have those massive context windows, memory is actually what limits you before raw processing power does. It's kind of like having this massive V8 engine, but a fuel pipe that's way too narrow. AMD is targeting that exact bottleneck. Meanwhile, Google's TPU-8T allows an insane 2 petabytes of shared memory per superpod. The hardware gap is closing, and it's closing rapidly.
And that leads us right into Section 3, the shift to inference.
You see, there's a fundamental divide between two very distinct phases of AI. AI training requires intensive, raw compute power. This has historically been NVIDIA's massive, undisputed advantage. But AI inference, the actual deployment and real-time use of the AI, that requires low-latency concurrent serving. We are officially entering the era of agentic AI, where autonomous agents are just continuously running in the background. And in this phase, operational cost becomes the critical survival factor. Google's TPU-8i was explicitly built for this. It's optimized for low batch sizes and high concurrency, directly attacking the most profitable segment of NVIDIA's future business by offering a much lower cost per token.
All right, moving on to our final piece, Section 4, Undervalued Alternatives.
This right here is the exact mathematical screening criteria being utilized by institutional value protectors right now to avoid the perfection trap. Analysts are rigorously screening for tech stocks with a market capitalization over $3 billion that are trading at more than a 20% discount to their fair value. They also need a greater than 50% upside target from analysts and must hold a robust financial health score of above 2.5 out of 5. These are stringent, highly quantitative metrics designed to identify significant upside without taking on extreme valuation risk.
So what actually passes this strict institutional screen right now? Well, here are two data-backed examples. First up is Pegasystems, ticker PEGA. They've seen their cloud annual contract value, which is basically their guaranteed yearly cloud revenue, jump 29%. Yet they are trading at an incredibly rare 11.7 times forward earnings, all while maintaining 75% gross margins. Second is Futu Holdings, a high-tech brokerage platform in Asia. They're boasting an astonishing 88% gross margin and executing an aggressive geographic expansion. These are companies showing incredibly strong cash flow and high margins, but at heavily discounted multiples. Literally the exact opposite of the perfection trap.
In a market this split, you are either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.